So a lot has changed with NICE stock. There's been a lot going around it. I covered it a few months ago on this channel, but like I said, a lot has changed, specifically after the most recent earnings. So I want to dive into that, but first, doesn't the new Yahoo dark mode look good? I wanted to use the term nice, but that pun is it's just not that good at all. So there has been a few things. So yeah, you're down 32%. Over the last 5 years, you're down 9%, but one thing with NICE is they were very high PE for a while. So back when you're at 276, your PE was in the 60s, I believe. Don't 100% quote me on that, fact check, but it was much higher than it is now. Right here, we're sitting at a PE ratio of about 24. If we look at the forward PE, we're at about 13. Now, we're going to look a little bit to make sure nothing's distorting that. Of course, you can have GAP, non-GAP, messing that up a little bit. However, over the last year, it's gone down quite a bit. Specifically, recently over the last earnings, that chart is terrible. Let's do 5 days. That looks a little bit better. I know it's kind of hard to see. This was earnings. It fell dramatically. I mean, it hit lows 140s, even like 147-ish, someone in the comments was saying, and we've already recovered a decent amount into the 160s now. So that earnings reaction, okay, let's dive into that. So diving into their earnings report, there's a lot here that is really solid. I mean, let's look at some of it. Q4 cloud revenue growth, 24% year over year. That when you're hitting above, honestly, anywhere above 18, 19, when you're getting into that 20 range, that is extreme growth. And you can do that by just calculating, 5 years out. If you grow at a 24% clip, where are you going to be? You're going to be very, very well. The average company, well, the S&P 500 grows right around that 10, let's say 12% if you're optimistic, 9% if you're conservative. Of course, when you're looking at long term, you have to take off inflation, so 3%. So you're kind of looking at that 7, 8, 9, 10% range, depending on how optimistic versus conservative you are. So if you have a company growing anywhere in the 20s, that's great. And obviously it wasn't the full company, but cloud revenue is very important. Operating income up 22% year over year. That's good. Operating margin went up. They're focusing on parts of their business, segments of their business that are higher margins. So generally that's pretty good. Earnings per share 28% year over year. That's very good, although that can be slightly distorted. Cash flow up. Everything that happened in 2024, at least this last quarter, was good. And then we get into some of the negative. And honestly, it's really not even that bad. Now it's not great. So Q1 2025 guidance, 10% year over year, which is a little bit lower than people thought. Full year guidance, it's just a little bit lower. So the full year cloud guide, basically people were expecting, let's say in the realm of, it depends on who was predicting it, somewhere from 2 to 4% more than where they guided kind of across the board, whether it be the full year outlook, the next quarter outlook, whatever it may be. But what I am still seeing here is I'm not seeing, 2% growth year over year. It's still 10% year over year growth. Well, year over growth at midpoint, right? And if it hits the higher end, it's even less. You're missing by 1 to 2%. And that's if you don't beat more dramatically. So, I mean, cloud growth revenue is still 12. Like I said, that's the optimistic growth for the S&P 500, and that's in the most important segment, the cloud segment. So yes, it might not be a smash out of the park home run, but it's not a bad, for a long-term investor, it's not a bad earnings. If you're a trader and you're hoping for a pop, yeah, this is not a great earnings. You were underperforming. But if you're holding this company 2, 3, 4, 5 years, if you keep growing at a rate like this, you're going to at least match the S&P 500, assuming, of course, it grows at that rate. I mean, but that is the average. That is the average growth. So this is not a bad earn, at least from a long-term investing perspective, in my opinion. So we covered the quote-unquote bad earnings already. Now what I'm most concerned about is the actual valuation of this company. Is this a cheap company? Is it expensive? There's two things we're looking at. We had a great year. We are growing like, let's say, an average company. Let's even say slightly less than that. But let's look at the valuation of it. So this is a company that we're sitting at just over a $10 billion valuation in terms of market cap. We're doing $2.7 billion in revenue. That's not bad at all. And like I said, we're doing 5.46 in income, operating income. Let's take a little bit of a look. Let's see if that's distorted. Let's see if that forward PE is accurate. So if you understand non-GAAP versus GAAP, GAAP is how we report PE. We legally have to do it. This is what we earned. However, when we look at the reality of things, sometimes there's expenses, one-time expenses, that kind of distorts it. For example, if you're paying off, if you get money from the government, right? That is a thing. You earn more than it looks like. Or if you merge with a company and you're writing off debt. That's happening in the case of AMD. That's why their PE looks crazy high. It's really not that high. If we're looking here, non-GAP is the actual GAP. Oh, actually, we're earning a lot less. The actual kind of PE we're looking at right now. I mean, we're growing, expected to grow 10% from what we guided. Revenue maybe closer to 7, so we're right in the earnings per share. We're right about an average company. And right now, we're valued somewhere in that 12 to 16 PE ratio estimating. Forward PE, somewhere in that, let's be conservative. Let's say 12 to 14 range. The S&P 500 right now is at about 30. So we are almost half the valuation of an average company. And we're a tech company. We do cloud stuff. Bro, we do cloud stuff. Now, the only thing I can see, if I understand this, is yes, people want higher growth if they're investing in a smaller company like this, right? $10 billion market cap. If you want 10% growth, why can't you just park it in the S&P 500? We expect more. I get that. However, you're still buying at nearly half the valuation of the average market. So if you're getting an average company at half the price, that's pretty good. But I also believe in the long term, a software company like this, you're generally going to have higher margins. You're in the cloud space. I think they're going to continue to do well, better than the average company. But like I said, even if they're average, eventually you will hit that equilibrium. The issue is there's a significant discount on smaller, specifically tech stocks. When they do well, obviously they go up. But if they don't perform like some incredible 20% year over year, they kind of get crushed. And you're kind of seeing that with NICE. They miss revenue and guidance by 2%, still growing like an average company, right? 9 and 7% revenue, and they just get crushed. That's the reality of it. So if you don't mind holding long term, and they continue to do like we expect they to do, of course, anything can happen, but if they do like we expect them to do, they should do just fine. But of course, anything can happen. That's just kind of how the market is at this point. Obviously, they've done well. I mean, if we zoom out, get a longer time horizon since 2015, you're still growing like an average company. S&P 500 is only up about 200% this time frame. You're right around that. A little bit less, I think. I don't know, just doing math off the top of my head. I'm not a math expert, but still, I'm pretty high on NICE. I think they're going to continue to do well. I think I've covered what I've obviously, of course, not investment advice. I think I've covered what I wanted in this video. Just wanted a quick update what I think about them after the earnings. So if you enjoyed, I'd appreciate if you like and subscribe. I do daily stock content on this channel. I'll catch you next time.